What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is October 14th of 2020. Well, folks, I hope you are having a fantastic day wherever you are. And in today's video, I want to spend some time to talk about the $31 trillion problem, or elephant in the room, for the traditional financial system that I believe is one of the top, if not the sole, value propositions for cryptocurrencies as an asset class, such as Bitcoin and Ethereum. And I'm not only going to be talking about what this problem is in depth so you get a great understanding of it, but along with that as well, showcase a lot of the symptoms or the signs from major hedge funds, publicly traded companies, and major financial institutions that are showcasing that this is the reality for Bitcoin and Ethereum. So we've got lots of things to discuss right after our quick sponsor. And our sponsor for today's episode is Altfins. Altfins is a free platform for traders to scan, analyze, and trade altcoins across multiple exchanges. In essence, it helps you discover trading ideas and strategies. It automatically recognizes 16 common chart patterns such as triangles, channels, heads, and shoulders, among others. It has many predefined trade signals, but you can also use the screener to filter coins based on technical indicators. You can create a watch list, monitor Twitter news, and also create alerts to help you stay on top of markets. The platform helps you monitor your portfolio of coins and trade history across exchanges all in one place. Check out the link down below in the description for more information. Alrighty, everyone, so let's go ahead and start off by understanding this big headline here, the $31 trillion problem. What is it? Why is it important? And why do I believe it's the major value proposition for crypto? So this headline here reads, JP Morgan says real yields are negative for $31 trillion worth of bonds. Now, I want to go ahead and just talk about what bonds are. For those of you who may not know, bonds are basically promissory notes from the government. They're IOUs, where the government is not only promising to pay back a principal that you've basically loaned out to the government. So to keep it simple, let's say I basically bought $100 worth of treasuries, and let's say that on those bonds there is a given yield and it's set for a certain maturity date, maybe 2 years out. I'm going to get my full principal back. I can basically materialize my bonds, and then I'll be able to get some kind of yield on top of it. That's basically what it is. It's a form of debt. And government debt is probably the biggest market, if not one of the largest markets on the world, probably sufficed by real estate. So we're talking about a very large market here, but there's a growing segment of the market that's becoming a bigger and bigger portion of that bond market, and that is negative yielding bonds. Now, you've probably heard about this before. Some people have talked about bonds that have a negative yield, and to many of you, it doesn't really make sense. It really doesn't make sense, but again, we're living in the twilight zone where people will pay for bonds that actually penalize them for holding it. But there's an even bigger problem here that people really aren't discussing. See, when you consider the yield that you're making on a bond in this case, being negative is already one concern. But the worst part of this is that we have to also consider that not only are you being penalized, but there is the real world factor of inflation. So the debasement of the actual currency itself. So when we factor these two negative elements that are becoming more and more abundant across the globe, we actually get a headline figure up to date that's $31 trillion, a massive segment of the global bond market. So I want to go ahead and actually talk about why, in this case, Bitcoin as an asset hedges against this to a degree. When we talk about Bitcoin as a digital asset, and we also talk about Ethereum, these cryptocurrencies that have fixed monetary policies, usually have deflationary principles, if not decaying inflationary principles, where there's less coins being generated over time. It builds this wonderful set of, basically cases where you're not dealing with a negative interest rate for owning Bitcoin, along with that as well, same with Ethereum. And you're also having basically a reduction in the inflation of the base currency of these digital currencies, right? So basically, this fixes all of the key issues that bondholders are going through right now. Sure, you're not getting a yield on your crypto directly, but you actually can through decentralized financial applications, as we've talked about here on the channel, through all the great tools that are being built in the space. But outside of that as well, you're also not dealing with hyperinflation or massive printing from central banks. Most of you are probably aware of this, but seeing the correlation, or I would say the lack thereof, almost the opposite nature of Bitcoin versus government bonds, it's a very valuable proposition here for digital assets, especially seeing as they're not tied or really controlled by any central government, right? So anyways, understanding this, right? How are we so certain, and how am I so certain personally, and why am I standing by this point that I truly believe Bitcoin, Ethereum, and other digital assets such as Litecoin and other cryptocurrencies could be a hedge against this? Well, I want to first off start off with the news that recently came out from Fidelity. Fidelity has been a very kind of progressive company when it comes to cryptocurrencies. They've been very forward thinking in regards to kind of enabling certain types of digital assets or opportunities to invest in digital assets. But the biggest thing here is that they recently came out with a massive report stating that they believe Bitcoin has a serious role as an alternative investment. Now, this is far beyond anything we've seen from Fidelity, not just the investment services they provide, but they've published an official report from Fidelity Digital Assets stating why they truly believe that something as far as a 5% allocation to Bitcoin is a reasonable strategy for people to invest. And I just want to emphasize how big this is, guys. It would be one thing if Fidelity said, oh, reasonable positioning would be, maybe a fraction of a percentage or a percentage. But this is beyond what most fund managers recommend for exposure to alternative assets like gold. So we're going to go ahead and talk about it here. There's a few other reasons here. You can read through the report. It's out there. It's public. It's available. It's free. But there are a few key points, really 4 key points that Fidelity brought up. The first point here is that investors' rationale for including alternative investments in a portfolio is obviously in demand right now. The growth and appetite for alternative investments is continuing to grow. The characteristics of Bitcoin that may make a substantial portfolio diversifier, so in this case, Bitcoin is something that's, again, people say it's correlated and not correlated. I don't think it's really the best term to use because it causes confusion. It's something outside of the traditional monetary system, similar to gold and silver. And historical analysis of Bitcoin's impact on a portfolio proves in this case to a very large degree over the last few years that Bitcoin has been on liquid markets and been investable. In this case, that it's been a great portfolio balancer to take kind of a higher level of risk and potentially have a higher level of reward, but with consistent returns. So there's a really good tweet here that I saw here from Jason on Twitter that I thought was really good. Just kind of considering the size and scale of this statement from one of the largest financial companies out there. Fidelity has $3.3 trillion in AUM, or assets under management. And if you were to get a 5% allocation of this, this is $165 billion in inflows to the market. Now, I don't want to go out there and say that all of Fidelity is going to do this. I think this is a bit of a generalized statement here, but I think it's a good point from Jason on this, that 5% allocation, when we're talking about the scale of, retirement accounts and money management accounts, we are talking about hundreds of billions of dollars. I brought up this statistic a long time ago that if you were to just capture 1% of the overall pension fund market, $44 trillion last time I checked it in 2017, probably well beyond that now, probably towards $50 trillion. You're talking about anywhere from $400 to $500 billion in this market that could go into digital assets, causing massive inflows, the likes of which we've never seen in cryptocurrencies. Again, hedging against the bond market, which makes up a ton of people's portfolios. I want to talk about another critical thing here. Obviously, the Fidelity news is big, but we're not just seeing this in major financial companies like Fidelity who are expanding their financial products. We're seeing this with major hedge fund managers and asset managers abroad. A $10 billion asset manager, Stone Ridge, has revealed a $115 million Bitcoin position as part of their larger plan and investment thesis. Now, again, this is something that we've already started to see with a lot of companies. We saw Paul Tudor Jones talking about his, 1% allocation to Bitcoin, even though, again, he's not owning actual Bitcoin. He's owning Bitcoin derivatives or some other type of financial product that exposes him to the price moves of Bitcoin. But this, again, is one of many signs here that we're starting to stack up and realize. And as I emphasize a lot here on the channel, these things don't happen overnight. It's a network effect, where people are starting to see, okay, wow, this investor starts to see Bitcoin as an asset, and this investor starts to see Bitcoin as a real-world asset. Maybe I need to stop ignoring it and do some due diligence and stop, having a blind eye to this new asset class simply because I don't understand it. And you start to see more and more people getting on the bandwagon of understanding, okay, wow, this thing actually has the principles and the features that I need in an asset to hedge against all the penalties that I'm facing in a lot of the bonds that I own. Right? And again, some people start to realize, again, as asset managers that, wow, my client's portfolio probably needs something like this. Now, this is not just Fidelity. This isn't just, again, a few asset managers abroad. Major banks like JP Morgan have called Square's recent purchase, the major payment processor Square. Many of them have called the $50 million Bitcoin investment that Square recently made that captured all the headlines as a strong vote of confidence for cryptocurrencies. So other major banks are starting to sit back and look at this and go like, wow, like major companies are starting to do this. Basically we can't ignore this anymore. We can't laugh off, like JP Morgan put out a terrible report about a year ago, maybe even less than a year ago, stating why Bitcoin was not a digital gold, why it wasn't a good asset, and basically listed all these really cheap reasons to bash on it. And again, now we're starting to see that, a lot of companies are like, wow, okay, maybe we need to, eat our own words, and we need to start, going out and offering these types of services, right? Now, again, the third component here that I think has been a clear sign of this for Bitcoin specifically that people have been talking about is the amount of companies that are starting, many publicly traded companies for that matter, that are starting to own Bitcoin, from smaller companies like Argo, DigitalX, Voyager, but along with that as well, Square, a major payment processor, and also a lot of major companies like MicroStrategy. They're kind of mid-cap companies. And of course, the absolute set of demand that Grayscale, CoinShares, and also BTCE and 3IQ, basically asset funds and management, ETNs in this case, are swallowing up the physical, or not so much physical, but the real Bitcoin supply, backing their exchange traded notes. Again, people in publicly traded markets want this exposure to digital assets, and they've been constantly paying varying rates of premiums, basically a higher price for the underlying Bitcoin, just to get exposure through these ETNs due to the limited number of shares. It shows that there's an absolute oversubscription of demand here, setting in demand for hundreds of thousands of Bitcoin, and this number is continuing to grow at a rapid rate. But it isn't just true for Bitcoin here. We have been following the DeFi narrative for Ethereum for a long time. Hayden Adams, over as the founder of the Uniswap protocol, who I've been following for a long time. I'm a big fan of Uniswap. We have it integrated into the Digifox wallet, which you can test out down below in the description. We have a link at the top. I wanted to say, $3.4 million of Ethereum, about 3% of the entire ETH supply, is locked up in the Uniswap protocol. This is massive. We're starting to see a lot of Ether that used to be used for pure speculation and used to be used for ICOs back in 2017 for projects that had little to no substantiation, now being utilized in real-world protocols that are building decentralized applications that do the same services we used to rely on centralized institutions in a better format. Along with that as well, the Crypto Lark, my good friend Lark, put out a really good post here talking about the launch of ETH 2.0 starting very soon. Again, we're not going to see the full ramifications of ETH 2.0, the scaling benefits, all these things until way later on. I hold a much more realistic view than I think a lot of people do. It's going to take a couple years. My target range is for late 2022, 2023. But I digress. At the same time, as we start to launch the early phases here, which is what Lark is referring to, we are going to start seeing the anticipation build, the more solidification that we all go on that path of launching ETH 2.0, it's going to benefit price more and more. And as we all know, with the Bitcoin futures launch back in December of 2017, it's the actual materialization of these things that tend to be at the peak of the cycle. So it's the anticipation that drives the bull market. And you can look more into this, learning about the kind of recent testnet trials for the earlier stages for Ethereum 2.0 through the actual blog post or through some of the news articles out there on the market. But last but not least here as well for Ethereum in regards to news is what's been going on in DeFi, the value proposition of the billions of dollars that are starting to be locked up and the amount of endless applications that are being built. Okay, so we've talked about the majorly bullish narrative here, and we've talked about, not only for Bitcoin and Ethereum, but also the problem here, the $31 trillion in negative real yielding bonds, right? Real yields being negative for over $31 trillion of debt. Right? But how big can this problem really get? That's the juicy question here that I don't think anyone's asking, right? I think there's been maybe some people who have talked about this problem. I don't see it talked about enough in crypto, guys. Come on, we got to talk about it more. But outside of that, right, the big question is how big can this get? I want to go ahead and talk about the broader bond market. Because again, I think people really get sidetracked when looking at crypto. They say, oh my God, Bitcoin at above 10,000, I'm late to the party. The Bitcoin and crypto, the overall crypto market cap is above $350 billion. Folks, it's nothing. It is a drop in the bucket when you're talking about larger markets like real estate that's an over $250 trillion market. When you're talking about global bonds here, which bear in mind, this is a chart here I'm going to show you in 2014, just to show you some time preferences here. Global bond markets were sitting a little bit under $100 trillion in 2014. That number now, again, according to our most recent estimates here in 2019, go to somewhere around $120 trillion. But I have no doubt that as this chart is limited to the data we have to 2019, with COVID and the response from governments across the world, we're easily over $125 to $130 trillion in global bonds. The printing binge that the Fed has gone through, but also the borrowing binge that governments have gone through, borrowing against their own currencies and their own central banks, has been absolutely phenomenal. Sorry, I was creating a word there. It's been phenomenal, not in a great way, but in the sense that it is significant in the sense of the historical context of the amount that governments have borrowed in the past. And what we need to realize here is as this bond market continues to grow here, we have an ever-growing amount of these bonds that are going through the negative symptoms that we talked about. We have the direct interest rates here, some of which are already negative in major countries like Japan, Germany, and Switzerland, which are very reputable and large-scale economies. But along with that as well, we also have even bigger economies like the US, Canada, and the UK, and also some smaller countries like Italy, now starting to teeter very close to negative interest rates. This chart is actually not up to date. The US is down to 0.25%. The UK is teetering right now very close. The central bank is already considering right now very seriously negative interest rates. And Italy and Canada are in already a worse off situation than this list right here. This is just showcasing the general decline here, right? So this data isn't even up to date. It's worse than this. And again, some of these negative rates have pushed even lower as well. So we have the core problem here, the $16 trillion. This is what most people are analyzing on the surface. Again, the level is even higher now. Again, this data, it's hard to get the absolute up-to-date data, but this was in late 2019. We're over 30% of the bond market here, right? Of the investment grade bond market. $16 trillion being in negative territory. But again, we have to consider the real negative yields here, which is considering inflation, which this doesn't account for. And if we're to consider this here, guys, I want to go ahead and I think I've got it pulled up here. We can see here that over 50% of countries' negative 10-year bonds in this case, so you've probably heard the 10-year treasury yields, 10-year bonds for other governments are now 50% more than they were in 2008 are in negative yielding territory considering inflation and the yields. And the reason for this is because if we're adjusting for inflation, these yields on the bonds are going to historic lows. Again, this data is slightly out of date here. We have to consider that as inflation has been continuing to ramp up, as central banks have printed more and more money, and rates have remained near zero, this is probably visiting historic lows for government bonds and the yields that they provide. So I have to ask you all this here. As we start to see more and more of the $120, $125 trillion bond market go into that negative category that we've been talking about, the $31 trillion worth of bonds right now, you have to ask yourself, as we start to see companies talk about 5% exposure to new different types of assets, exposure that would usually go to your bond portfolio, we start to see major companies who are managing their treasuries, the cash on their balance sheet, the other assets, and they're now starting to allocate it into this new digital asset such as Bitcoin or Ethereum. And now we're starting to see major hedge funds and money managers starting to look at a serious 1, 2, 3, 5% allocation to Bitcoin. What does that tell us here? It tells us that people are starting to wake up to the value proposition here for Bitcoin. They understand that historically speaking, it constantly sets higher significant lows and higher significant highs, and has a relatively predictive pattern as an asset due to its halving model, and along with that as well, the sheer fact in this case that Bitcoin, being an emerging asset, is going to have parabolic rallies and pretty stark corrections. Rallies that in many cases continue to leapfrog the asset from being a multi-million-dollar asset to a multi-billion-dollar asset, and in this cycle will leapfrog it, in my opinion, upwards towards around a $2 trillion valuation, if not more, in the sense of its market cap, pushing prices well towards around $100,000 for Bitcoin. It sounds crazy at the start for many of you who might be getting in for the first time, but don't let the price get to you here. $2 trillion in the sense of the valuation, that's what matters, is nowhere near. It is a fraction, right? We're talking about the peak of the Bitcoin market here. A $2 trillion valuation for Bitcoin is nothing comparative to the already $12 to $13 trillion gold market, the $120 to $125 billion global bond market, and the over $250 trillion real estate market. It is a blip on the map, and it is very realistic to see this happen. So when you're looking at Bitcoin and other cryptocurrencies, realize you're early to the game. And we're just getting started here when it considers all of the factors, when we're considering all the factors in the macro perspective of what's going on in the global economy right now. Just think, what would a 1% exposure in pension funds or retirement accounts do to Bitcoin as an asset? I'll let you be the judge of that. Anyways, I've rambled on enough today, guys. If you like this video, please consider dropping a like. I always like to ask towards the end of the video just to make sure you guys, for those of you who really actually stuck around, gives me a good sign of what you guys want to see here on the channel. And if you could, consider subscribing, hitting the bell icon, and checking out Digifox down below. If you're just getting started with crypto, you're looking to get tapping into DeFi and really put your assets to work, earning interest, or your stable coins, or your dollars in this case, to earn a better interest rate. You currently earn 10.94% through Celsius. Don't think you can get that at any major commercial bank. I'm pretty confident of that. So if you're interested in those kind of yields, definitely check out Digifox down below. Make a deposit today and give it a shot. But all in all, guys, thank you all so much for the continuous support, and I'll see you all in the next video. Take care, everyone.